No matter what you do in life, no matter what dreams you chase, if you have a degree to fall back on, you're always safe. Well, they don't tell you that there's a $180,000 price tag attached to it.
Student loan debt has been steadily increasing, affecting approximately 44 million Americans.
It's just normal. Everyone does it.
The student loan problem has reached epidemic proportions.
I'm paying all these bills and I have nothing.
I know people that are planning to die with that debt.
You've agreed to pay it back. When you don't, give me your pound of flesh now.
This is the most important financial decision in your life.
No one is going to stop you from borrowing.
It's not good debt.
Every piece in the system did what it was supposed to do.
Certainly seems like a very large amount of corruption.
And the victims are 17 years old.
The choices that they made now own them, and they do not know what to do.
Is that the American dream?
Okay, welcome back to the PCA Uncensored podcast. I'm Tony De Cesare, Vice President of the Patriot Club of America, here with my good friend Jeff McDonald, President of the Patriot Club of America. So that was quite an eye-opener by Dave Ramsey. But before we dig into that, I want to go ahead and do a quick follow-up on our last episode with Johnny Olszewski and the donors that are funding his campaign. And apparently we were sent a piece of material by one of the members regarding Johnny Olszewski. So you want to go ahead and follow up on that real quick?
Absolutely. As we continue Tony De Cesare's with the adventures of the Baltimore County Executive. And as you know, ladies and gentlemen, the truth does not have an agenda, hence why this is called the PCA Uncensored Podcast, which means that if we get something wrong, we want to hear from you. So part 2 on our illustrious county executive's adventure. First and foremost, before I get started, Tony De Cesare, as we explore the latest happenings with the county executive, he claims that his administration has been the most open, accessible, and transparent in Baltimore County history. So let's get started. It seems as though, and again, wasn't ever a real fan of the Baltimore Sun, but it's been bought out, and I want to give credit to the Baltimore Sun for doing this article. Obviously, it's behind a paywall, and as you alluded, we had a member who was able to forward this to us. I guess they downloaded it or whatever, but Baltimore County spending $550,000, ladies and gentlemen, of your money to shield the 2022 settlement to brother of county executive's friend. So let's dig into this. Baltimore County John Olszewski Jr.'s administration secretly paid his friend's brother an $83,675 settlement after backing out of an agreement to increase the retired firefighter's pension, which county lawyers said would have violated state law.
Oops
is right, and oops. I don't know about you, Tony De Cesare, but $83,000 is $83,000. And again, ladies and gentlemen, it's not the county's money, it's your money. So, and now the administration could pay more than $500,000 of your money on a fight in court to keep secret details about the settlement. The Baltimore County Council agreed July 1 to allocate an additional $200,000 to pay outside lawyers in a former county official's public records lawsuit after already settling, Tony, for $350,000.
That buys a lot of groceries in the Joe Biden economy, by the way.
Yes, it does.
That's a lot of cash. So I think what we'll do is let's keep an eye on this. Obviously, the Johnny O material just keeps dripping out now. So drip, drip, drip while he's going through his campaign for his 2nd congressional district run. But it's kind of funny because I ended up, when you sent me this information, I thought, wow, that's a that's a pretty scandalous little piece of information. So I just so happened, as we discussed on the last podcast, I went online and checked the FEC website to see whether or not this individual had actually donated to Johnny Olszewski's his campaign.
And the answer is?
He did.
He did.
He did.
I'll be darn. Amazing how that happened.
Circular money.
Circular money.
Okay, so we'll go ahead and drop that, but that's a good follow-up to the Johnny Olszewski story. Obviously, we're going to keep our eyes on this. There's still a lot of time before the election. Do you have anything you want to add?
I have one other thing that I want to add to this, because as Tony alluded, the PCA Uncensored podcast focuses on not only local things, but national things as well. And as we think about, as you just alluded, Tony De Cesare, John Olszewski is vying for the 2nd Congressional District in Maryland's House of Representatives seat. Once again, it's we owe, and off to public office goes Johnny O. So take it away, Tony.
Okay, so that was a good follow-up, and I appreciate our members reaching out to us and sending this.
That's one of the wonderful things about the PCA is our members are engaged and involved.
Great that was great. That was a good follow-up. So let's jump back into the video. Obviously, that video was made by Dave Ramsey, and it's a fantastic documentary. It's called Borrowed Future. You can get it, I think, on Amazon. It may even be, actually, I think it's for free on YouTube. But I watched it a couple of years ago, and it was just like heartbreaking to watch some of these stories of these people who had taken out this insane college debt. So this episode of the podcast is called, Debt Nation. We're 30-some trillion dollars in debt at this point as a nation, and these kids just keep tacking on to that same debt mindset. So,
Debt Nation is a great title.
Student loan crisis is going to be a problem. So,
yes, it is.
I watched the video. And then about a year or so ago, Charlie Kirk wrote a book, and it was called The College Scam. And I had heard about it. I have the Charlie Kirk.
There it is.
Charlie Kirk, The College Scam. This is a great book. If you have kids that are getting ready to go to college, I highly recommend reading this book. I think Charlie Kirk has done a great job for the younger, championing all this stuff for the younger generation. He really calls them out. And really, this is a book about, it's a 10-count indictment on the college system. So it's not just about academia and how things have changed culturally, but that is in the book. And the first 3 indictments of this are really based on the financial part of what college has become. So, the 10-count indictment, as you go through, he makes the argument and the point as to how this needs to be fixed. So, the big 3 with Charlie Kirk in the book, colleges and universities are running a scam, number 1. Total scam. Number 2, college education is ridiculously overpriced. And you can see that. I'm going to go ahead and throw that graphic up. The average cost of college tuition over the course of the last 20 years. Look at that. And then the universities have become obscenely rich at the student and taxpayer expense. So when you analyze this and you look at how the system, and we're going to break this down for you, and particularly for the people that are looking to send their kids to school. When you look at the way this thing is set up, it's a no-lose situation for the universities. They get all the benefit.
As Jack Nicholson said in One Flew Over the Cuckoo's Nest to Nurse Ratched, you like the rigged game.
The game is rigged.
The game is rigged.
So the funny part is that as a student, as a college student, you go away, you're 17, 18 years old, and they always talk about going to get you financial aid. Well, financial aid is just a buzzword for student loans, and that's just a buzzword for debt. So they acquire all this debt, and they sign these documents, and they don't necessarily understand 100% about what they're getting into.
Well, that's a great point. And the fact is, you're literally doing it on campus, and you're doing it with a representative of the campus in a line. You get to, it's your turn, and all you do is, ladies and gentlemen, is start signing your life away. Just sign here. It's all going to be wonderful because you've been accepted. You're on the property of the campus. All you have to do is sign this stack of documents, and away you go to be indoctrinated.
Right. So the problem is the student takes on all the liability.
Yes.
They take 100% 100% of that debt on. The universities and the schools take on zero liability. They just take your money. So do they have a vested interest in you graduating? Do they have a vested interest in you actually paying that note back? And the answer is no, they don't really care, okay? They get all the money, you get all the debt. So the answer to the problem is, and this is a very simple solution, if you tied the university as the co-borrower to that debt, the balance sheet changes pretty dramatically because now they've got a vested interest in making sure that you pay that back.
They are a co-signer.
Make them the co-signer.
Just like a lot of our parents did when we bought our first car, and they told us, remember, you don't make the payment, I'm on the hook for your car, and it's not going to be fun.
That's a great point. So if you think about this from a finance standpoint, when you go to buy a car and you sit down with the finance manager, the guy that they pull out of the back or whatever, and you fill out a credit application and you say, I want that car right there. And the finance manager says, okay, well, let's look at how much money you make. Let's look how much debt you have. And they run through all these financial numbers. And then they say, well, Jeff, I'm sorry, you can't afford that car, but we can get you enough money to buy that car over there. And when you leave there, you know exactly what your monthly payment is going to be. Okay? And they used to give you the little stubs, the pay stubs, the coupon book. Right. So you walk out of there and you know how much money you're going to owe. When you apply,
and you know your interest rate.
And you know the interest rate, which is usually fixed. So then you go and you buy your first home and you sit down and you go apply for a mortgage at a bank. And they do the same exact thing and you say, I would like to buy this house over here. And they say, Jeff, unfortunately, we can only lend you X amount of dollars. And this is what your payment is going to be for the next 20, 30 years, whatever it may be. They actually give you an amortization table that shows you how much interest and how much principal you're paying every month. When you sign up for a student loan, they do none of that. They just lend you the money.
Show me the money.
Oh, not back to that again. Calm down. We're going to get in trouble with that. So you think about this. You don't even know what you're going to be paying in the end. And you're like, okay, well, I'll just sign. I'll take care of it when I get to the end of the road, and I'll start making payments then. So that's an important point to remember. Well, when you start digging into this, many years ago, it used to be a private lending institution like a bank that would give you a loan.
The banks would compete.
The banks would compete for the loans. But then the federal government decided, instead of us being the guarantor for these private loans, we'll just lend you the money. Well, they didn't have it to begin with. They just printed it. But today, the federal government owns 90% of all the student loan debt. Now, before the federal government decided to become the bank, they wanted to make sure they got their money back. So they said, if we're going to be the bank, then what we need to do is make sure we get our money. So we're going to make it really hard to discharge that debt in court. So if you go to bankruptcy, in many cases, and we're going to get into that in a second, you can't get rid of that debt.
Correct.
So now you're stuck with it. You're going to die with this debt. If you don't pay your mortgage, what do? They foreclose and take your house.
Exactly.
What if you don't pay your car payment?
A man comes in the middle of the night, known as the repo man.
Repo.
I think there was a movie made about it. And away your car goes on a flatbed.
Bye-bye.
And you break out your old bicycle.
So in the U.S., as of today, it's collectively over $1.7 billion. Trillion. My bad. $1.7 trillion in student loan debt. It's the second largest amount of debt next to behind home mortgages in the country and growing.
So there's approximately, and we'll use round figures, 360 million people in America today, right? Of which I don't know what the percentages are, but let's just use 360 million. 10% is 36 million, right? Which means that as of today, more than 44 million Americans hold federal student loans.
That's where things are starting to change. So you see all this sort of like progressive thinking on college campuses, and the vibe has actually changed over the years. and that's a different conversation for a different
Oh,
day.
yes. That's
But
a podcast in itself.
it is. And so now what you see is this drift of these millennial Gen Z kids walking away from all of that because the real life implications of the debt are now catching up with them to a certain degree. So right now, 24% of millennials still hold.
4%.
They still hold student loan debt.
So when millennials, and I'm not really sure of this, what age group would a millennial be right now?
It's like the 90s into like up to 2000.
Early 90s? Would you say
So
90s?
no. So Gen X is like to 80, and then I think millennials is like 80 to maybe like 95 or 2000, and then it's Gen Z.
So the millennials
Gen
would
Y,
be
Z.
right now.
They're in their 30s.
I was just going to say. So think about it. 24% of early 30-year-old adults, and let's think about us when we were in our early 30s. I was on to my second home. I had started a family, so on and so forth, with zero college debt. And since and let's go back, we remember which wonderful president all this started under.
Right.
Good old Barry Obama. So when we were that age, again, most of us were starting families, so we'd already purchased a home. And unfortunately, 24% of those people at this age group now have student loan, and it's not small.
It's not small. And the average person that takes out a student loan, the average borrower takes 20 years to repay their student loan debt. So if you talk about buying your first car, buying your first home, remember, when you signed up for that loan, you really didn't have to worry too much about filling out financials and applying for it. But when you buy a car or you buy a house, you have to sit down and they go through all that and say, oh, you got a $1,200 a month student loan payment. That's going to be a little bit of a problem as far as buying a home.
Exactly.
It's keeping them out of the housing market. I mean, cars are a different story. You can buy a beater car or whatever. But the craziest part about this is the more I researched this and the more that I looked into it, the 3 states with the highest debt per borrower.
This is good. Yeah, this is great.
Maryland at $43,280, Georgia at $41,935, and Virginia at $39,719. So Maryland is at the top of the list for the largest student loan debt. But in those 3 states, the average debt per student is near or above $42,000. Washington, D.C. has the highest debt per student overall at $54,863.
So near or above $42,000, DC with $54,000. That could buy you in cash a very decent car, or
very decent.
Prior to the insanity with the housing markets, that in cash could have bought you a hell of a starter home.
Correct.
Right?
Correct.
And this is all current. These statistics, ladies and gentlemen, are current as of January of this year.
Correct. So that's what's keeping them out of the housing market in many cases, is that this revolving debt. We're not even talking about the credit card debt and things like that. This is just something you got to pay every single month. And it's like these kids are getting beat over the head with debt. That's where you see the drift away, from the progressive mindset into the, conservative, more economical mindset. And that's why this big trend is starting to happen. That's the reason that I looked into this. I had no idea why we have these young people showing up at our events and things like that. So it's like every time they turn around, they're paying. It reminds me of this National Lampoon Cup. We're going to go ahead and run that right now.
Yeah, absolutely. The hammer over the head.
What's the bill?
What's the bill?
Come on. How much?
How much you got?
No, I'm asking how much the repairs are.
I'm asking you how much you got.
You're out of your mind. Look, I don't have time to play around, okay? So how much is it?
All of it, boy.
What does your sheriff think of your business practices?
Okay, so
Total truth through comedy.
Right.
And how old is that movie, by the way?
It's 84.
It's timeless.
Right, it is timeless, but that's a great analogy. So as I look through that data, I have a good friend of mine, colleague, Ed Chrisman. He's a bankruptcy attorney. So I called him up because I was just curious if this had any impact on like bankruptcies. And this guy's been doing this stuff for years and decades or whatever. And when I called him, I said, "Do you have any data that you can provide to me?" And he said, "Sure." And he started breaking it down based on the number of bankruptcy filings. And we're going to use Maryland as an example, but in like 2018 and 2019, there was like just under 17,000 Chapter 7 bankruptcies filed in the state of Maryland. Well, then 2020 comes along, and the world gets turned upside down, and those numbers change, and it was a little under 10,500. So you saw this dramatic reduction. Well, then 2021 pops up, and there's still government money flowing into the economy. They're still printing money. They're still, providing these handouts, and there were less than 8,100. And a lot of that had to do with the fact that COVID had shut down the courts. There were mandates coming out from the government not to foreclose on properties. There was, rent forbearance and no repos, no foreclosures and things like that. So you see this drastic cutback to like 8,000. The money was still there in 2022 from the government. People were still getting these forbearance, and the number of bankruptcies dropped to 7,250.
In 2022.
In 2022. Then 2023 pops up again. The money flow got cut off in 2022. So then it's up to 9,400 in 2023. This year, this is like only halfway through the year, there were 6,250. So you're looking at going back up to like 12 or maybe 13,000 this year. And it's going to continue.
These are dramatic jumps. I mean, dramatic jumps.
What's going to keep going? That's the thing. It's starting to catch up over time. And, I asked him, I said, it seems kind of funny. 2018 and 2019 were pretty good years economically, but you had this huge number of bankruptcy filings. And he said, well, in his experience, in good times, people overspend.
Yes.
So, they're not too concerned because the faucet's still running. But in bad times or in down economies, they become very thrifty. Very thrifty. So you see the absence of vacations. I saw a statistic. He sent this to me. Oh, it's on my phone. It's 24% of the people they surveyed said that they were actually skipping meals to save money. Wow. And I was like,
how sad is that?
Yeah. And the big part about the student loan debt, because it just keeps getting bigger and bigger and bigger. And I said, my question to him was, can you discharge student loan debt in bankruptcy? Now, in the beginning, this is pretty crazy. He said it used to be very difficult. He said maybe a few dozen out of millions every year were discharged in bankruptcy. And they've had to change some of that because it's a two-step process. You have to go through what's called an advisory proceeding to discharge the student loan debt. And this is funny. If you want to file a regular bankruptcy, it's it's like $1,200 to $1,500 to do a Chapter 7 filing. If it includes student loan debt, it's $5,000.
So think about this. You're completely upside down. You're going to file bankruptcy, and it's going to cost you another $5,000, which would be a huge payment on the loan. And the other thing is that I find quite amazing. I actually was talking to a young physical therapist who's a great guy. He just got engaged, so on and so forth, and he's paying down, obviously, a tremendous student loan from the University of Maryland. And he said, and I did not know this, that they have the option, and ladies and gentlemen, if I get this a little wrong, please bear with me, they can just pay on the interest. So
correct.
So it's, again, the government created the monster, and now the current sitting president, who is not going to be running for a second term, has attempted to come back as the hero. In other words, the arsonist who started the fire at the back of your house is now selling you the fire extinguisher at your front door. they are going to relieve, which is unconstitutional, the student debt. But my point is, he's saying that he can, if he wants, just pay on the interest while the principal just sits there, or vice versa.
So that was the whole thing with the student loan when they did the forbearance, and everybody said, well, you don't have to pay your student loans. Well, it was forbearance on payment, not forbearance on interest.
There you go.
So the clock's still ticking. You're still you're accumulating more debt while you're not paying it, which is one of his suggestions was to just pay the interest. So you're getting clobbered over the head, and you sent me this great clip, and we're going to play that in a second. And this goes back to 1946 from the old.
It's a Wonderful Life.
It's a Wonderful Life with
Jimmy Stewart.
Jimmy Stewart
plays George Bailey, but the most amazing thing is the reason we wanted to play this clip, ladies and gentlemen, is it is from a philosophical and reality perspective. It's so true, and it was true then as it is now, how a choice few have constantly tried to get control of everything, and it drives them crazy when there are we the people standing in the way. So do you have anything?
Well, hold on. You got to prep that because a lot of people don't know the story behind it, but George Bailey's father dies.
Yes.
And his uncle was also one of the...
Uncle Harry.
Uncle Harry was one of the principals that owned this building and loan at the time. And they would lend money to people to purchase their first home, a mortgage, and then they would go ahead and pay them back. But you have the big banker that now wants to purchase it and buy it out. No different than corporate banking today, sucking up all the small independent banks, right?
Yeah.
And what ends up happening is he defends them. So let's go ahead and run that. You want to add one thing?
Yeah, I do want to add one thing, and I misspoke. Harry Bailey was his brother. Uncle Billy was the uncle, and at that point in the movie, the Bailey Savings and Loan is the last independent bank in the town. So, and the interesting thing is, everyone thinks that It's a Wonderful Life is a Christmas movie. It's not. It's Frank Capra who did It's a Wonderful Life. He did Meet John Doe. He did Mr. Smith Goes to Washington, among many others. What he was trying to do is a first-generation Italian immigrant who had experienced the horrific tyranny of socialism in Italy, was such a patriot. He was trying to show people the difference between communism and capitalism.
Right, so we're going to go ahead and roll the clip, and then we'll come right back.
Borrow money. What does that get us? A discontented, lazy rabble instead of a thrifty working class. And all because a few starry-eyed dreamers like Peter Bailey stir 'em up and fill their head with a lot of impossible ideas. Now, I say...
Just a minute. Now, hold on, Mr. Potter. Just a minute. Now, you're right when you say my father was no businessman. I know that. Why he ever started this cheap penny-ante building and loan, I'll never know. But neither you nor anybody else can say anything against his character, because his whole life was... Why, in the 25 years since he and Uncle Billy started this thing, he never once thought of himself. Isn't that right, Uncle Billy? He didn't save enough money to send Harry to school, let alone me. But he did help a few people get out of your slums, Mr. Potter. And what's wrong with that? Here, you're all businessmen here. Doesn't it make them better citizens? Doesn't it make them better customers? You said that what'd you say just a minute ago? They had to wait and save their money before they even thought of a decent home? Wait for what? Until their children grow up and leave them? Until they're so old and broken down that do you know how long it takes a working man to save $5,000? Just remember this, Mr. Potter, that this rabble you're talking about, they do most of the working and paying and living and dying in this community. Well, is it too much to have them work and pay and live and die in a couple of decent rooms and a bath? Anyway, my father didn't think so. People were human beings to him, but to you, a warped, frustrated old man, they're cattle. Well, in my book, he died a much richer man than you'll ever be.
I'm not interested in your book. I'm talking about the building and loan.
I know very well what you're talking about. You're talking about something you can't get your fingers on, and it's galling you. That's what you're talking about, I know. Well, I've said too much. You're the board here. You do what you want with this thing. There's just one thing more, though. This town needs this measly one-horse institution, if only to have some place where people can come without crawling to Potter. Come on.
Okay, so obviously you can see from the clip, George Bailey defending what they were doing, and you've got your big conglomerate banker up there, all bloated, trying to blow him off. We're going to go ahead and take your bank anyway, George. Too bad. Sorry about your dad. That kind of thing. It was like very impersonal to him or whatever. But that movie clip is, 1946. Yes. You're talking 70-some years old. That's what's happening to millennials right now.
Absolutely.
Okay, they can't even get in the door of those places. It's the same thing with the generation behind them. So they're throttled by this debt. Chrisman, I had a few other questions to him, and really it's this meme which I sent to you. Do you have a copy of that? The Proverbs meme I sent you.
I do. So Proverbs 22:7, the rich rule over the poor, and the borrower is slave to the lender. How true is that?
It's
today?
still the same.
It's timeless,
right.
Absolutely.
And
the borrower is slave to the lender.
Exactly. So that was when I talked to Ed Chrisman about that. He's like, absolutely. And I said, well, you're a bankruptcy attorney. You see these things happen all the time. What is it that you would recommend? Right. First and foremost, avoid debt as much as possible. You can say what you want about Dave Ramsey, and a lot of people like him, a lot of people don't. I've read a lot of his stuff. I've watched a lot of his videos. He has gotten more people out of debt than anybody in this country.
And that's a beautiful thing.
Exactly. I mean, he has turned people's lives around in very short order, and he is built on that same mantra with the debt and the credit for years and years. And that's the thing. You ask the majority of young people out there, who's Dave Ramsey? Who? And that guy has saved people's lives. So avoid debt.
Literally.
Save their lives literally. So avoid debt.
And let me say this about that real quick. Avoiding debt. Think about it. You've got 2 sons. My children went to college as well. It blew my mind, and the subject is college debt, that my kids, when they were in college, would get mailed to our home, you're pre-approved for your first credit card.
Back it up another step, because I got into an altercation when I was coaching in college with one of the banks that sets up the tables in the unions, and they sit there and they want to give these kids $1,000 credit cards all the time, and they're like, here, sign up. Well, they have no credit, so they're going to give them like $1,000, and they know it's baked in that a certain percentage are going to default on that credit card right away, okay? So what they do is they basically put a ball and chain around your ankle, because now your credit score has gone down because you've defaulted on a $1,000 credit card. And now you got to claw your way back up. I mean, the majority of these people don't understand, the value of a credit score, your FICO score. I mean, if you want to talk about social credit scores and things like that, that's where it starts. That takes you out of certain areas of the economy. If it's not good enough, sorry, we're not going to give you this. So avoid debt as much as possible. Okay. The second thing he said, and this made a lot of sense, was 75% of his clients lack financial literacy. Now, when I went to school, we had a class, I don't remember what it was called, but they taught you how to balance your checkbook and, just basic life skills and things like that. Kids don't use those tools anymore because everything's digital. Here, let me Venmo you. Here, let me send it to you on Zelle. Here, let me put this on my card. When we went to a bar when we were in college, I said, Jeff, let's go to a bar. And you'd say, great. I said, well, how much money do you have? And you'd say, I don't know. And you'd stick your hand in your pocket and you'd sit there and go, oh, I got $40. I'm like, okay, we're going to go to Poor Richard's because it's 2 for $1.
Or spin the wheel night.
Or spin the wheel.
Spin the wheel night? For those of you in Baltimore County who are north of 50, you'll know exactly what I'm talking about.
Right. So you knew exactly what it was, and you were limited to that budget or whatever it may be.
Yeah.
They don't work that way. So they lack financial literacy. And he said, if you don't understand it, get financial advice. Go to someone that understands how this system works. Number 2 was live below your means. So I think what's happened, because we're this big consumer society, we have to buy all this stuff or whatever the hell it is that they throw in our faces, and consume. they don't understand that. They need the next vacation. They need the next iPhone. I think my phone's 9 years old, by the way. I don't really care, but my point is, like, I never
went back to a flip phone.
I wish they did too. But live below your means.
You know, it's funny you say that, because where we're recording is I was driving here, and you see it. It used to be that people would be happy with you know, a 3-bedroom, 1 or 2 bath on a half an acre. You see so many of these McMansions because we've been programmed to keep up with the Joneses, so on and so forth. You see these McMansions just plop down everywhere, and these people build them. They're brick fronts, and the rest is either vinyl or aluminum siding. And you see so many of them that the back has sliders that are supposed to go to a deck, but they ran out of money.
No deck.
And the deck is the siding of the deck built into the sliders so they don't fall out from the second floor to the ground.
They've been well, that's the whole thing. People have been like oversold.
Yes.
I remember growing up, and Ed and I were talking about this, like my friends, when we went to their house, one of the big things was, like, if you had your own room. Like most people that had multiple kids, you know, they had brothers and sisters that had shared a room, and having your own bathroom was an even bigger deal. But like, you know, not anymore. Everybody gets their own room and their own bathroom and things like that. But live below your means. People over borrow is what he was saying. So live below your means. And the last thing, which is brilliant, and this I had to learn this, you know, when I was young, is to create a relationship with your lenders or even your banker. I mean, I used to go into my bank and they knew me by first name. My banker knew me by my first name. And if something was up and it didn't look kosher, my phone rang.
You know,
hey, there's some crazy stuff going on in your bank account. I just saw I just saw like a big transaction. Did you guys do that? Yeah. So somebody's watching.
Right, so think about it. We're old enough to remember. And if you live in Baltimore County, Baltimore City, so on and so forth, that one clip from It's a Wonderful Life where George Bailey and Uncle Billy are attempting to save the savings loan from Mr. Potter. There's another scene where there's the run on the bank.
Right.
And where George Bailey does a wonderful but very simple explanation of economics or banking 101, which is, the money's not here. It's in your house, Tony. It's in your house, Bill. It's so on and so forth. Because you and I are both old enough to remember that every community, including Baltimore City, Baltimore County, Harford County, and again, we're broadcasting from northern Baltimore County, but the point is, there were independent savings and loans everywhere. I first banked with Bradford Savings and Loan, which was a local savings, and you're spot on, Tony.
It's a community
bank. They
bank.
knew me, I knew them, and like you said, if you got in trouble, like I remember a couple times, I bounced a couple of checks, and I said to them, I wasn't paying attention, and they said to me, Jeff, we're going to give you a break this time, but it is your responsibility that when you write that check, you make sure there's enough money to cover it. And it was a lesson.
Right. Well, that's the whole point, like overdraft protection.
Yes.
You know, they say, hey, you bounced a check. Let's go ahead and give you overdraft protection. But just so you know, it's 18% interest when we put that money back in your account. I mean, like, we're going to do you a favor for 18% interest. So you're welcome. Right. That kind of thing.
That, I think, of the four wonderful points that Ed made, that is huge. Creating relationship with your lenders, because it's harder to do now, but I guarantee you that if you get out of your car and go, let's say you bank with M&T, and you go into the same branch consistently, you'll get to know them, they'll get to know you, and relationships can save you a lot of heartache.
I'll tell you how I learned that the hard way, is that I created a relationship with our banker, and I realized that she would invite us out to go to dinner, and I was like, free food. I like the way this bank works. I'm going to stay with you, right? So they buy you a meal, and you know, they sell you all kinds of expensive money, and you pay it back. But anyway, I think the point is this, and we're going to close on this piece. This is actually very important. So there's a meme. It's been going around forever, and this is a very, very good point. And I think it's important because it's an election year. and people are starting to wake up and see the consequences of how elections have panned out and how it's impacted them personally from an economic standpoint for the most part, but even for opportunities that don't exist anymore. But the meme says this. It's actually not a meme, it's a quote. The forest was shrinking, but the trees kept voting for the axe. For the axe was clever and convinced the trees that because his handle was made of wood, he was one of them. Remember that in November.
Amen.
Remember that in November.
Amen.
Just because the axe has a handle made of wood doesn't mean they're one of us.
Pay attention to the issues, not the identity.
Amen. That's it for today for this episode of the PCA Uncensored Podcast, and we'll see you soon.
Ladies and gentlemen, thank you very much for tuning in.